Hello, everybody. Thank you for participating in the Morgan Allen Associates webinar. And today we look into trends and opportunities in the real estate market post-pandemic. My name is Enrico Vignoli and I am partner in Morgan Allen Associates. Morgan Allen help businesses to address strategic and operational underperformance and helps finding solution and funding and financial problems. We can help clients to develop and implement restructuring strategies, to exploit the global opportunities, whether through investment, international expansion, new market assessment and development, or through external acquisition. And of course, to optimize their financial structure. The webinar. Today's webinar, thanks to such an eminent panel, today's webinar is oversubscribed. So let's discuss about this important subject with our panelists. And I am delighted to introduce Mr. Aaron Taggart, Head of UK Investment at Sheney Capital in London, Angelica Crystal Donati, CEO at Donati Construction Group in Rome, Alasdair Pritchard, partner at Knight Frank International Superprime Sales in London, Aldo Atanasio da Ponte, CEO at Arbitrage Group, London, Marco Bertazzi, CEO at JCS and Executive Chief at GH Group, Luxury Real Estate in Milan and Garda Lake. So now I am inviting our panelists to introduce themselves quickly. Let's start with Mr. Taggart.
Hi, Enrico. Thank you for inviting me on the panel. My name's Aaron Taggart. I head up the UK business at Sheney Capital. We are predominantly a debt provider of debt capital across Europe. Our main geographies are UK, France and Germany, but we're also investors in Italy and Iberia and Scandinavia as well. So predominantly debt capital, but also equity, and we can play and invest up and down the capital structure.
Thank you. Angelica Crystal Donati.
Hello, everybody. Good evening. Thank you so much, Enrico, for having me here this evening. It's a pleasure. So my name is Angelica Donati. I am a construction and real estate entrepreneur. I'm also a specialist on the topics of construction and real estate technology, so Comtech and PropTech, which are topics which are very popular right now as we shift into a more digitized era for real estate and construction.
Thank you. So Alasdair Pritchard.
Hi, Alasdair Pritchard here. You'll have to forgive me from working from my car, but I think if there's ever a world we can get away with doing this, I think it's this world. I work in our private office. I look after our top 5–10% of clients, high net worth, looking to spend 10–20 million plus per asset, largely on the residential side, but given the nature of who the clients are, obviously helping advise them on commercial and hospitality assets as well.
Thank you. Aldo da Ponte.
So thank you very much for having me as well. My name is Aldo Atanasio da Ponte, and I'm the CEO of Arbitrage Group. We are a boutique real estate company based in central London, and our primary focus is central London developments, and as well as an agency for prime central London.
Thank you, Aldo. So Marco Bertazzi.
Hello, good evening all, and thank you for this opportunity. My name is Marco Bertazzi. I'm CEO of JHS Company and Chief Executive of JH Luxury Real Estate. We are specialized in the real estate market on the Garda Lake, and not only for the trophy asset hotel in all the rest of the country.
Thank you, Marco. So now we are ready to discuss about trends and opportunity in the post-pandemic real estate market. But before we start, let me remind you that if you have any question, please use the chat function on your screen. Thank you. So I would like to start with Aldo. Aldo, specifically with the UK and London market. Can you hear me, Aldo?
Yes, I can.
Okay, good. So with your company, you are involved with residential, retail, and commercial market. How was 2020 in general for UK and London in particular? Apparently, for what I'm reading, the rental market was very poor, and since the rental reached the lowest level in 10 years, apparently. The sales market was not as bad, since for what I'm reading, in this very central area in London, prices went down only by 0.4%, and the rest of London actually went up by 1.4%. So what can you tell us? And something as well about your typical client, which is the affluent Italian individuals and Italian companies. Aldo.
Sure. Okay. So the market is very varied across the different sectors. You have the residential market sector, which in 2020 it's obviously it's been challenged, but it's proved to be fairly resilient compared to other markets. If you just take the total return for 2020, the residential total returns have been almost 2.5%, and this compares to -1% for office and -10% for retail. London, and especially prime central London, it's obviously been affected the worst out of the pandemic, simply because it has to be reliant on domestic buyers compared to the traditional investment buyers which come from overseas. Obviously, with the travel restrictions, you could not get the international buyers into central London, and therefore there's been a lower level of activity. What's interesting, though, is that the market still remains at -21% compared to the peak reached in 2014. You're right that rents for residential properties have fallen in London, and especially in central London, by almost 13% in 2020, while in outer London, they've been fairly static. Just to give an idea, rents in the wider UK market have actually increased by almost 4%. For prime central London, the reason for the decline, and the substantial decline, is mostly due to the lack of international students, professional and tourists, which make up a large proportion of the market for residential letting in central London. For the non-residential markets, an interesting data is that only 48% of rents have been collected in the whole of 2020. So less than half of the rents in retail and office have been collected in 2020, which gives you an idea of the devastating impact of the pandemic on these two sectors. When it comes to retail, obviously you have forced lockdowns which have affected disproportionately the non-essential retail. And interestingly, there have been a couple of reports from Savills whereby only 19% of shopping malls rents have been collected, compared to the high street being 58% of rent paid by the tenants. What we have experienced in central London is that landlords are increasing the levels of rent-free and the capital contribution that they provide to tenants in order to incentivize tenants to stay in the property rather than having empty properties and vacancies which could last for many months. What's interesting also from the office perspective is that 2020 has been a very low activity year for both office letting and office investments. And you have a decline in activity by 75% in lettings and 56% in investments. And that's particularly true for central London for a couple of reasons. One is that central London is very predominant in terms of the international office take-up. And obviously with the travel restrictions, you have people simply not being able to do views and view properties. So the investment activity and the letting activity has gone down quite dramatically. And also you have another factor, which is the working from home, which seems to have become a trend, essentially. So the point that you make about the Italian investors, which make up a good part of our client base, we've seen a decline, obviously in activity, albeit there's been a large pickup in the last quarter of 2020. The initial statistics of 2021 is that the pickup has been cemented, and that there is investors looking for opportunities.
Okay, in fact, talking about 2021, it seems that already in December, the trend started picking up for sales, because what I'm reading is that in December, there were more transactions being finalized and more mortgage granted by banks. And as well now, for the first quarter of this 2021, I'm reading the house price forecast from Savills, which has been just published, and they predict for the average UK house price an increase in 2021 of 4%, an increase even for prime central London about 2-3%. With more transaction, by the way, they say that overall in 2021 there will be 33% more transaction than in the past years. And for central London, they predict in the next 5 years a total increase of 21% or more. So what do you say about this? What is your view? What do you expect for 2021?
So we believe that the residential momentum, which has been building up in the last quarter of 2020 and the first quarter of 2021, will continue for the whole of 2021. There's been a rush in completing transactions in the first quarter of 2021 because of the stamp duty holiday, which everybody thought it would come to an end, and is now been extended to June 2021. When you remove this support mechanism from the market, the stamp duty holiday, probably there will be a likely reduction in activity as the year progresses. But with that, we also need to face the potential increased confidence that will come with the rollout of the vaccines in the UK and in the rest of Europe and the world. And with the lifting of the travel restrictions, that should bring back the international investor in central London as well. And that's very interesting, because everybody in the markets expects higher inflation over the next years, and historically, prime central London residential real estate has been a good hedge against inflation, which the market expects and has built in over the next few years.
Okay.
Coming to retail, for the to give you an overview of other markets aside from residential, you have the huge shift from the physical location of retail, the shop, to online, and that's a trend that we think is likely to continue. We've been supported in this view both from our clients and the experience that they tell us, as well as by surveys that have been carried out for the likes of CBRE, whereby almost 1/3 of shopping will be done online by 2025. When it comes to offices, obviously there has been the huge shift from physical office working to working from home. And another survey that was carried out showed that about 70% of companies will continue with flexible working in terms of location post-pandemic. And that's obviously is going to have an effect on the office take-up. So we expect that 2021 will probably be a low growth or a slight decline for the office markets, which will continue in 2022 and will likely pick up in 2023 as the employment grows post-pandemic.
Thank you. Very interesting. Thank you very much. So now we go to Marco. Marco, with Aldo, we have just seen the trend in UK and London and a forecast for 2021. How about Italy in 2020? Can you confirm a similar trend to escape from cities and to move to country, a small town? In terms of transactions and prices, what was 2020? Was it very bad, or for instance, it seems to me that from what I'm reading, at least for the residential market, the year was not as bad as you can expect. So what can you tell us, Marco?
Yeah, the positive trend in Italy started from the end of the lockdown. According to the analysis by the Real Estate Market Observatory, buying and selling volumes in the residential sector increased by the 8.8%, with 15,500 more homes traded compared to the Q4 of 2019. Compared to the third quarter of 2020, the positive trend also extends to the provincial capitals, with an increase of 2.9%, even if the smaller municipalities did much better, with an increase of 11.8%. Particularly interesting were the findings in central Italy, which showed an increase of 16.8%. And in the same areas, there was also an increase in the capitals of 6.9%, which is the highest among areas throughout Italy. In the Northwest and Northeast, while the increase in the capital was 1%, in the other smaller municipalities, there was an increase of over 10%. It's therefore clear that the sharp fall in March and April 2020 was contained by the increase in the following months. It's therefore confirmed that 2020 closed with a decrease compared to 2019 from a forecast of minus 57.7%. to an overall decrease of 7% on all the year. Since November, the figures had started to rise again and included the capital cities. The trend in the 8 main Italian cities was decidedly different. The market had come to a complete standstill in Palermo, Naples, and Torino, while Rome and Genoa recorded an increase of around 8%, with the biggest falls in Milan, minus 8.9%, Bologna, 5.4%, and Florence, minus 3.9%. Those 8 cities show a trend of partial recovery by the end of 2020. It's in particular interesting to note that while there is a general increase in the number of homes bought and sold in Milan, the trend is toward the purchase of homes 20% smaller, but with private terraces apurtenant to the flats. As far as price are concerned, according to the data I checked on Instant, in the third quarter of 2020, there was an increase of 1%. The prices of new houses increased by 3%, and those of existing house by 0.7%. For 2021, the trend is absolutely upward. The first 2 months of 2021 have marked significant increases, continuing to the growth of the third quarter of 2020. So I believe that the positive trend will touch all of 2021 and certainly in all of Italy. Okay. In general, I haven't noticed the real escape from the big cities, but there is certainly a tendency to find houses with more openings to the outside, or a search for houses with an extra room, multi-purpose. On the other hand, the requests are accompanied by the slightly smaller budgets. Obviously, I'm referring to the ordinary residential market.
Okay.
To the top level market is something else.
In fact, since you are normally deal is very often with the very high end of residential market. I mean, you deal very often with luxury residences in historical buildings and nice country houses and hotels. I remember you had a big business with hotels in 2019.
Yeah.
How about this type of market? How was 2020? And how is going to be, in your opinion, 2021 in the near future?
Okay. As is always the case, the hotellery market starts after the ordinary market, the residential market, has recovered. In this last year, obviously, from May 2020 until now, two different types of investors have appeared in the hotel market. Speculative investors, who are obviously looking for the real estate bargain, counting on the financial catastrophe that is hitting part of the Italian business. Or the institutional investors who, considering a recovery in the hotel tourism and business sector, are shifting their interest from the retail and office market to the hotel market. The management market is suspicion of the introduction of smart working. And the attitude of investors is very cautious. Is correct?
Cautious, yes.
Cautious, thank you. Sorry for my bad English, but it's many years that I don't speak in English. So, before being able to define the trend of the sector, it will be necessary to wait for the recovery, since many companies have detected an operational decline in their employees of about 30%. And for companies, it's important to verify carefully a definitive introduction of smart working. Luxury is only suffering from the absence, in particular in Italy, of Russian and American clients. But I must point out the last year and the first few months of 2021, my company increased its transaction by the 31.5%. And I am a personal satisfaction. Obviously, we have the good fortune to be located on the Lake of Garda and to enjoy a select clientele from Germany as well. I hope to see an upturn in Tuscany and my beloved Venice in the near future. For this, however, I must wait for the return of the English people and also of the American people. During the last meeting with the company's top management, however, we hypothesized an increase in the invoice of a further 30% by the end of 2021.
Okay, good, thank you. Mr. Taggart, so 2020 has been quite a difficult year that has affected our living in many ways. It could have been worse without the financial support of the governments in many other parts of the world. Global cities have suffered so much with these inhabitants being dispersed and tourists told to stay away, like Aldo as well was mentioning the impact on many aspects. So the trend has been to escape from big cities, but now with this vaccination rollout, we start seeing a sort of light at the end of the tunnel. With the light at the end of the tunnel, we can see the magical word of recovery. So when do you see a recovery? How is it going to be? Which is the key factor for a faster recovery, in your opinion?
Yeah, I think in London, for example, we've seen an outflow of people to the tune of 700,000, which is a remarkable figure, really, when you think about it. But hey, I'm pretty optimistic that the vast majority of these people do come back to London because, London just offers so much, and the large global cities, whether it's Milan, Rome, over where you guys are, or whether it's London, New York, it's just multifaceted in terms of what it has to offer. So I'm pretty bullish on London and the global cities that what they have, you can't replicate, and you certainly can't replicate in a very short space of time. So if anyone's thinking, they'll certainly in the UK, that there's going to be a large diversification away from London into smaller towns and cities, I just can't see it happening. You know, I just think that certainly for young talent, if you want to attract and keep and retain young talent, what large cities like London have to offer is unmatched. You know, you'll be working with the brightest of the best. Number one, you'll be working for some of the best companies in the world. Number two, you'll have, you know, fantastic life outside of work and great buildings to work in. Do I think there's going to be change? Absolutely. There's always change. And maybe what COVID has done is accelerated that change. So we think that there will be, we've separated real estate, I guess, to give you an idea of how we think, we separated real estate into structural and non-structural. And what we mean by that is, out of COVID, what subsectors of real estate are going to go for a structural change? So we've seen certainly in the UK, as maybe Aldo alluded to earlier, a real change in retail dynamics. And that's just accelerating. So that shift from physical retail to online retail, I think, is just a one-way trade at the moment. And if you're a retailer at the moment, or if you're an owner of shopping centers, you really need to entice retailers or purchasers to your destination. They have to become destinations. And if not, you're going to have a vortex to oblivion. So that's definitely one trend. If you are, let's talk about another structural change, maybe hotels. Yeah, hotels. I'm not particularly bearish on hotels, and I do think that tourism really starts to pick up again, hopefully in the second half of this year. And I'll go back onto my predictions. You're asking me when this kicks off again, and to what extent it comes back, and I'll give you an answer on that. But certainly in terms of hotels, maybe some of the corporate demand doesn't come back. In terms of certainly if you overlay ESG considerations and your global footprint and your carbon footprint as a company, as an individual, maybe you won't be traveling to see your clients in Europe or the States 3 times a year. Maybe you'll speak to them twice a year via virtually and once a year physically. So that wouldn't surprise me in the least. And so but all of this is going to take time to normalize. And I also think that with regards to offices, I don't see this as a massive structural change, not to the level that some people are predicting. I do think that there is going to be this more flexible working, undoubtedly. But I don't see a wholesale change. The death of the office has been absolutely overstated. I speak to you from an office and I'm not alone in saying that I couldn't wait to get back. And so I see that as a trend going forward, where employers just have to be flexible, and each person's requirements are very individual. It depends how old you are, depends what stage of life you are, whether you've got children or not, what work it is that you do, what company you work for, how far is your journey into your office. Every decision is incredibly individual. Right. So it'll be fascinating to watch that journey. In terms of how this comes back, I'll summarize quickly just by saying, certainly in the UK, I see this coming back in the second half of this year very strongly. I think the number that I've seen is that the average British saver has saved an additional, well, in total, we've saved an additional £100 billion over this period, which is an incredible sum of money. And I know for a fact, just by taking a straw poll of people that are around me, that people just can't wait to get back to going on holidays, going to the cinema, going to eat out and drink out and socialize. So I do think that there is a huge amount of pent-up demand. And certainly the Bank of England over here is predicting that GDP will be back to pre-COVID levels by the end of this year, which is an incredible turnaround considering what we're seeing at the moment. But the vaccine is the big thing. All right, you alluded to it earlier. And the only thing really that stops that, I say, as someone who had mine yesterday, and it's incredibly efficient. I have to take my hats off to the government. They've put a system in place that is incredible. But the only thing that potentially slows this down really is other variants. But I personally, from all that I'm seeing and hearing at the moment, don't see that as a massive break on anything. I do think that the economy will really, in the UK, fire up in the second half of this year.
So for this revival of small and medium city, you believe that we go back to the big cities in pretty soon after this main
I don't know what it's like in Italy, so I'm not going to compare. Let me just tell you that the satellite towns around London cannot give you what London gives you. Simple as that. Yeah. And to recreate what London gives you, and maybe Milan or Rome or Turin, it's going to take you. I've lived in London nearly 50 years. Let me tell you, it's an incredible city. It changes every day. It looks better every day. And so I think the prognosis for London as a city is incredibly strong.
Right. Thank you. So, Angelica, I have a question for you now. So, this pandemic has affected the real estate world, as we heard before. In your opinion, which are the main issues that we have seen during the year of the pandemic and the sectors that have suffered the most? I can hear the call for a new concept in commercial buildings, a new flexibility with the working environment, new concept for residential as well. They say as well that we need to pay more attention to digital connectivity and to human well-being. What is your view on this, Angelica?
That's a lot to unpack. Let me try and answer in different segments. So to answer your first question regarding what the most hard-hit sectors of the market have been, that is very easy to answer. Retail, first of all, and hospitality. Retail and hospitality have suffered the most. And with regards to physical retail, the big question that remains to be answered is, will retail survive? Will retail as we knew it before the pandemic ever exist again? The high street was dying pre-COVID, and it kind of just accelerated things that were already underway. The big winners in the pandemic, well, the big winner was logistics, as online purchases increased and consumption trends shifted firmly from offline to online. Obviously, logistics has been the clear winner. And actually, across EMEA, the residential space has also performed better than expected, probably because institutional investors looking to put their money into yield-bearing assets started investing more in the multifamily space. As for the office space, it's been discussed already during the course of today's talk, so I'm not going to go into it too much, but there's been a push towards flexibility. So there is a massive question mark around the question rather of what the office of the future will look like, and my answer to that is that it probably will be more flexible. I agree with Aaron wholeheartedly. The city will never die. Big cities will continue to be hubs for our everyday and our work lives, and people need human contact. And even though what the pandemic has taught us is that you don't need to be in the office every day, you don't even need to go to town every day to work effectively and live efficiently, big cities will never go out of fashion. But it is also important to note that if we invest in our physical and digital infrastructures, this new let's call it hybridized approach to living and working could bring value to smaller cities. We were talking about Italy, for example. There has been this push for decades to try and repopulate some of the inner rural areas like the ancient borghi, which are emptying out, and houses are being sold for €1. The same is happening in certain areas of the UK. And the big question mark is, can we leverage these new habits that are starting to emerge to encourage people to perhaps not move out of cities permanently, but to live in areas that they wouldn't necessarily have lived in before, while still going to the city to work, perhaps not every day. But the problem is you don't answer that question until you've answered the question of the physical and digital infrastructure that you need to put in place for these things to happen seamlessly. So in today's world, the answer is no. In the future, if we invest properly, then that could be an option as well.
Okay, very good. So my second question was, even there is 160 global developers that have been asked, and they publish a report, they answer. They mentioned that the big city will still be an engine for innovation and economic growth. There is no doubt about that. But they, in any case, they highlight the need to tackle critical sustainability concerns. So they say in the long-term strategy must be, as you mentioned before, smaller, self-contained, amenity-rich district. So your view is consistent with what they say here, that you agree that we need really to, in the long run, to improve this aspect of a city.
The topic of sustainability is one we can't run away from anymore. I think one of the things that the pandemic has driven home for everybody is that these tail risk events are not so improbable as we think they are. And so now that, I wouldn't say the pandemic is under control because it isn't, but now that we're starting to see how we can come out of this emergency, industry players are rightly starting to concern themselves with tackling the next big problem, which will be around sustainability, especially because in Europe, we have a European Green New Deal that we've all adhered to, European countries have adhered to, and we need to target zero net carbon emissions by 2050. So cities, which are the biggest polluters on the planet, and as we all know, human capital keeps on flowing into cities, so urban populations are only going to keep on growing over the next few decades. Cities are the biggest offenders, and cities need to become sustainable. Now, I think there is a series of ways to achieve these sustainability targets. It isn't just kind of pulling people out of cities, because objectively you can't make them leave, but it is also thinking about the built environment holistically in a more sustainable way, building more sustainably, managing properties more sustainably, building sustainable infrastructure, and as you rightly said, also trying to add value to more remote areas where people might now want to live, given that they no longer perhaps will have to go into work every day.
Right. Okay. Thank you, Angelica. So let's go to Mr. Pritchard, the golden word of the very rich people. So we understand that private wealth continues to grow even in the pandemic. In all crises, the private wealth grows, even in the pandemic this time. So ultra high net worth individuals, those lucky enough to whose wealth is more than $30 million, increased by 31,000 in 2019. I don't have any number for 2020, but the forecast is for 2024, an additional big increase of 27% of the original number of 2019, which was 520,000 people worldwide. So high net worth individuals always love the real estate market, and especially those safe haven locations like London, New York, Paris, big cities. So what did you see in 2020? Which was the trend? Did they still enjoy and invest in real estate, or they changed?
I think it never changes, really. I mean, I suppose that everyone has a tangible love of real estate. You live in it, you breathe it, you invest in it, you have it as a safe haven for your kids to live in London whilst they're at university, say. So there's a whole raft of sort of lifestyles that go with these assets. And I think the one thing that we've seen in the last 12 months, as is ever the case, never play God with your clients. They will always surprise you, and they will always come up with some weird and wonderful requests. We've had, a range of clients that if it wasn't for lockdown, I don't think they would have bought what they did buy, because they got stuck in London in a 2-bed flat in Mayfair that they've only ever really used for, say, 4 weeks of the year. And then they've been trapped there for 2 months, realized that it's too small, they can't work from there. and they've become £25 million buyers purely on a basis of they've had time to think and work what they like and what they don't like. You know, I've had clients who you would have always had as typical to want to live in a certain way, and now they're looking to move their tax residency to Italy because they want a little bit of lifestyle. They want to take advantage of the res non dom tax play, and they want to try and find a balance of working from home, living a good life, but also having the benefits of tax. And they've moved out of a very small apartment in Monaco to now what's going to be a very big sprawling estate in Tuscany. Again, if it wasn't for the lockdown, I don't think that transaction I did in Tuscany would have happened, because my buyer would have done his usual in and out of Monaco on his boat, go to Corsica, Sardinia for the summer, go hunting in Scandinavia in the winter, and it would have just been the continual cycle. So I think what, you know, sort of in line with what all the other guys have said, that whether you're 200 million plus, $1 billion plus, or even in my little world of my wife and my family, if it wasn't for lockdown, we wouldn't have bought a house in the countryside as well to try and have the best lifestyle. So I think it's got everyone thinking, it's pushed everyone's decision making forward a lot sooner. And luckily, I'm fortunate enough to work for a platform like Knight Frank, where we have 700 offices all over the world in every jurisdiction with 120 odd service lines. So we're ready to field all of these requests. And whether it's to buy somewhere in New Zealand, to sell a hotel in Tuscany, to buy residential real estate in the Hamptons, we've been able to field it. So it's been a jam-packed year, and one that we could never have predicted to have ended up where it has.
Right. So even for your typical client in 2020, you saw more interest in areas where they had more far from central cities and more near the seaside or lakes or Switzerland.
Yeah, a bit of both. I mean, we've had clients who have been sitting on the fence trying to buy a house in London. And I think, again, the advantage of COVID, I mean, today, why I'm sitting in my car, we simultaneously exchanged and completed on a transaction today in Belgravia at 50 million that I've had under offer for, would you believe it, 413 days. It's been an SPA transaction, so a very complex transaction. But I think if it wasn't for COVID and therefore the buyer's lack of travel, he's not been sort of distracted by other offerings, or he's not too, he's sitting in the Middle East at home wanting to go ahead so that he knows when he can travel later this year, if he can travel later this year, he's got a house to come to. So COVID as well and all the various lockdowns have pushed people into making decisions. In my world with clients, it's very easy for these guys to say, hey, we'll be in London in 2 weeks, we'll make a decision then. 2 weeks becomes a month ends the summer. That means they're on their yacht in Saint-Tropez. And then before you know it, 8 months has come by and they've still not come and seen that house they thought they were going to buy. So, we've bizarrely done deals at 30 million, 20 million, 42.5 million off FaceTime. I mean, the amount of time, I've even had to invest in one of those sort of image stabilizers just so I can walk around a house virtually showing a client so that I can actually give him the full experience and not get my thumb in the middle of the, of the camera lens or be too shaky or breathing into like the microphone and put them off. So we've had to change our day-to-day with how we service clients, but in terms of appetite, it's never been as strong. We just struggle to find the stock at the moment. That's our biggest problem.
Very interesting. Thank you. So I will go back to Aldo. I would ask something about 2021 and Italian investors that normally are coming to London or to invest. So there are two issues that could be a problem for 2021. The first one is the additional 2% for stamp duty, which is coming soon, starting from April 1st for all people, individuals, non-resident in UK that are buying properties here. So this is affecting Italian investors. And the second item is the EVA tax. EVA is a tax which was introduced in Italy in 2011, But this year, 2021, for the first time, the calculation will be much different. It will be on the purchase price or market price of a property is equal to 0.77%, which is a big problem. So Aldo, what can you tell us about these issues? Is there any way how he might affect the market, and any way we can do something here?
Sure. So the prices in prime central London are still 21% below the peak in 2014. So even with the extra 2% in stamp duty from April 1st, London and prime central London is still seen as a good value at present. If you take London and the UK and compare that to other major cities in the world like New York, Paris, the cost of buying, holding, and selling real estate is still much lower than other major cities in the world. So I think, yes, it will have an effect. It's going to have a lesser effect than people think, simply because of the differentials that you have between London and other cities and other major cities in the world in terms of taxation. When it comes to tax structuring, for example, you can mitigate the tax increase of the percent using simple UK limited companies, which could provide a shelter against the higher taxes. And in terms of the specific of the Italian EVA, this wealth tax, Italian investors are that own a property outside of the EU are used to this kind of level of wealth tax. So an Italian that purchases an apartment in New York, it's already paying the wealth tax EVA on the purchase price or the market value of the property. So I think there is a shift in mentality that with Brexit, something could have happened, and that's one of the consequences of being outside of the EU. With a tax advisor, we started looking at EVA, and there are ways of mitigating the impact of EVA for Italian nationals by, for example, the use of UK limited liability partnerships, which could provide a shelter against this wealth tax in Italy. Obviously, tax is one of the factors that you look at when you purchase a real estate in a different country. There are other factors, and obviously, as Alistair was saying before, replicating London in other places is difficult. And I was reading today a study carried out by Boston Consulting Group, which just came out, that London has been voted again the most desirable city to live and work in. And I think it's something not to be underestimated.
Very good. Thank you. Thank you, Aldo. So Marco, a question for you again. I understand you are dealing very often with very important foreign clients that come to Italy to buy, to live or to invest. Yeah. In your opinion, they coming for the traditional reason, the art cities, the way of living, the climate, or is there today something new, some new reason why investors from other countries, they come to Italy? What is your experience in that?
No, I think that the increasing sales to foreigners speak for themselves. They are coming and will continue to come. And I believe that the reason are those you have spoken about before. Most foreign come from Europe, European countries, historically English people, German and French, but there are also buyers from America. The foreign real estate market has always been sustained by people of mature age, wealthy and with a high cultural level, mostly interested in luxurious homes. In the recent years, the profile of the foreign buyer has diversified, and a new trend has developed in favor of a middle-class public interested in the comfortable homes where they can spend their holidays or even their old age. Foreigners buying a house in Italy are mostly looking for a second home or a home to spend their lives in. Our country is highly sought after, in fact, for the tranquility and serenity of the Italian lifestyle, accompanied by good food and artistic beauty to be discovered. Many foreigners prefer detached houses such as villas, farmhouse or cottage, with many rooms and surrounded by a green area also is very, very important. Perfect for spending a peaceful holiday with friends or with family. The properties should be well maintained and well finished, preferably, renovated while maintaining Italian architectural and stylistic characteristics. This housing choice allows you to enjoy tranquility and be able to reach towns or beautiful landscapes in a short time. Flats are not the first choice for foreign clients, except in historic cities that can offer a great artistic and cultural heritage, as well as comfort and convenience of big cities, including Milan, Rome, and Florence, for which there has been an important increase compared to last year. And Tuscany is the region favored by foreign buyers, thanks to the wide range of landscapes it offers, from the sea to the mountains, good food, historical heritage it can offer. It's followed by region facing the sea, such as Liguria, Puglia, Sardinia. Finally, Lombardia is in high demand, especially for its beautiful lakes, and the Nesrid mountain also. Undoubtedly, one of the reasons for buying is the fascinating artistic, cultural, and historical beauty. Any new question or any new choice. Moreover, our country offers a wide variety of different landscapes. This is very important to remember. From the breathtaking mountains of the Dolomites to the crystal clear sea of Sardinia, from the Tuscan countryside to the tranquility to the lake Garda or Como.
Thank you.
Yes,
thank you, Mark.
I hope also the return of the Russian people, because it's a very, very important range of clients.
Okay, so for Aaron, I have another question about the commercial real estate. In 2019, there were more than $300 billion invested in 1 year in the commercial real estate worldwide. This amount was the triple amount in comparison with 10 years before. I understand that family offices did play a big role in this growth, and investors in general, together with family offices, always regarded the real estate asset class as a very important one for opportunities in different geographies and sectors. You know, furthermore, it allowed them to diversify from the market, from the equity market, which can be very volatile. So, do you believe that they need to rethink a working space, the change in working culture, the work from home solution, which is now after the pandemic, could result in a sort of crisis for commercial buildings and therefore in a change of investor appetite or not? What do you think?
quite a long question. I will try and answer it as best I can.
Yeah, but it's just if the commercial building is going to be in a crisis for this or not.
Okay. All right. So my view is that it's not going to be in a crisis. No, I think one of the telling facts of this crisis and the pandemic has been the lack of distress. There's a huge amount of money being raised to take advantage of distress during the pandemic, and there's very little distress around at the minute. And I think that's probably a consequence of a combination of banks being better capitalized this time around compared to global financial crisis, and being able to weather the storm better. I think also equity is probably better at supporting their investments, and probably better at negotiating with lenders and also banks to say, look, the good times are coming. Yeah, we just need to hold on for a little bit. So I think I'll go back to the answer I gave earlier about the structural and non-structural, depending on your real estate that you've invested in. So if you're asking me if commercial is going to have a crisis, if you're talking about the whole of commercial, non-residential, then I think it's very specific. It's going to be very specific to geography. It's going to be very specific in terms of what type of commercial do you have? Do you have a second-hand office, for example, or do you have a brand new office that's fit for purpose and looks fantastic and can adapt to the new way of working? I think it's going to come down, as real estate always comes down to, incredibly granular detail, unless it's retail. Retail is, as I alluded to earlier, it is really has its own issues, its own problems. And as I said previously, either you make your shopping a destination, or you stand a chance of dying in the future as the world changes. So look, if you're asking me also about residential, people will always want to live in a nice place. I agree to a large extent with some of the other guys have said, Alistair, for example, that we see probably a couple of different themes playing out in terms of residential. So we really like co-living as a concept because it offers more than just living. In the new world of potentially working from home and working from the office, co-living gives you, hopefully, fantastic. If you've invested in best in class, it gives you fantastic amenity to work from that is for free. You get that as part of your package, which is amazing. And so it also alleviates then probably the two key issues about working from home. One is you're working from your bedroom or working from a confined space, which is always an issue. And secondly, the loneliness of working from home. So when you're working out of a co-living space and you're working in the communal areas, you'll alleviate both of those issues. Also agree with a trend about if you're only coming into the office 1, 2, 3 days a week, you probably will therefore suffer a longer journey. You'll be happy to wear a longer journey. So maybe you live out a bit further and buy more space because you're not doing the journey 5 days a week. Maybe you're doing it twice a week. Maybe you're doing it 3 times a week. So I think there'll be a trend in terms of suburban housing. So I think in summary, I don't see commercial falling off a cliff. The times it falls off a cliff really is something is massively structural, like retail, or there's a huge amount of distress. And I don't see any of those things happening really on a large scale in commercial.
Right. Thank you. Thank you. So, Angelica, I have a question for you, and a question from me, a question from the attendees. Angelica, you there? Okay. So the first question is there anything positive from this year of pandemic? I mean, something that some new way of living we learned during this pandemic, like the work from home solution, or other aspects that you believe it could be something positive that we maintain in our way of living and in the market forever? This is the first question from me. And then there is a question from the attendees that say, what do you think it will happen with investment linked to leisure structures, such as, for example, theme parks, leisure, and other amenity like that?
Okay, so to answer your first question, there is always a silver lining if you look for it. And I think in this specific circumstance, it's been the acceleration in change, and especially not just change that we've discussed today in our call, but the acceleration and uptake of technology within real estate, within construction. So let's look at PropTech. PropTech has been on the rise since 2015, but never as in the past year has it been really become rooted in the market, rooted in the built environment, as owners and operators have had to embrace technology in order to continue running their assets. And that is transversal if you look at residential, if you look at commercial, and everything in between. It's just become a part of the new normal, this embracing technology, because people are perhaps no longer able to go on site for property management purposes, or maintenance needs to be managed more efficiently from remote. Portfolio returns need to be optimized because obviously there has been a reduction in occupancy rates, and so utilities need to be made more efficient. A whole host of reasons have driven owners that perhaps were complacent beforehand, owners and operators that were complacent beforehand because they were making a lot of money anyways, and therefore didn't feel the urge to adopt technology. But now with a moment of crisis and also a moment of intense change, they have had to embrace technology, and this is not going to go away. As for your second question, I don't know about leisure parks specifically. I don't have any data. I would imagine that as with everything that requires people to commingle in restricted spaces, it'll be a while before people go back to theme parks. I cannot imagine the queues at Disneyland being very long for some time. But there, as with everything else, we were talking about the hospitality industry and how, for example, hotels have taken a big hit with the massive reduction in world travel. I speak to a lot of VCs on a daily basis, and several have told me that they're looking at hotel tech for the next year, because they think that hospitality is going to be one of those spaces that will recover and will innovate and will do so by embracing technology.
Okay, thank you, Angelica. So now I believe we are nearly at the end of our time. So before we finish, I would like to ask one common question to all of you, which is the same question I will ask everyone for your answer. Where do you think it is the best opportunity in the market in 2021 and the near future? So Aldo, would you like to start?
Yes, so I'll try to be short because I'm aware of the time. Yeah. Some of the emerging trends that we have seen of the lockdowns will continue in 2021 is being less flats and more demand for houses with gardens and space for an office. These trends in London, traditionally for the family house markets of Chiswick, Fulham, Putney, and Richmond, and we think that this will continue in 2021. Meanwhile, if we take prime central London, the strongest markets for 2021 are Notting Hill, Holland Park, and Bayswater, because these areas combine local amenities, access to green space, walkability, and good family housing stock.
Right. Thank you, Al. So, Marco, for you, the best opportunity in 2021? I don't know if you can hear us. So let's.
Sorry, but I have the employees that need help.
Quick answer, because we are nearly there. We have finished 1 hour. But if you have an idea, quickly, what is the best opportunity in 2021? A city, a type of house, what else?
The best opportunity, absolutely, for my core business is the hotel in Rome. Okay. In particular, the hotel in Rome, a little bit in Florence, and also the hotel in Venice. I think it's two, yes. In Milan, I don't know. In Milan, I must wait the work in progress I have.
Yeah, and after I can... The hotel in Rome. Thank you very much. So, Mr. Taggart, Aaron, what is your
Yep. Okay, it's not. I'm not going to say an immediate trend, but I'm going to say that if you are not investing or developing with a really sharp focused ESG lens on at the moment, you are going to pay for it in the future. So I think if you're looking to create either offices, residential, student, hotels, and you're ahead of the game in terms of ESG, your assets will be worth more than non-ESG focused in a very short space of time. It will come to value very, very quickly. You will have a bigger pool of investors and buyers. So if you don't have that lens on now, then you're not future-proofing your investors' capital.
Thank you. Thank you very much. Now, Angelica, you are
So I'll jump onto the tails of what Aaron said, and I will add not just ESGs, but tech as well. Tech has become a moneymaker for real estate, and it is going to become an investment criteria because tech-savvy investors will want buildings and portfolios that can be managed effectively through the use of technology.
Thank you, Angelica. Alasdair, your point of view for the best opportunity. I don't see. I don't know if his connection failed. He was in a very difficult situation, but so at this point, after these final remarks, which have been very interesting because we have some ideas, what's going on, what is the best opportunity in the market for 2021 and the near future. So I believe it is time to wrap up, and let me thank all great panelists and the attendees. I hope that you enjoyed this webinar and this has been interesting, that you did find the answer you were looking for. So keep following us in our website, because we are working on another couple of interesting ideas for our next webinar. And in the meantime, keep safe, not be scared for the vaccine, and goodbye. See you soon. Bye-bye.
Thanks. Thank you, everyone.
Thank you.
Mm-hmm.